The legendary investor Benjamin Graham once said, "Successful investing is about managing risk, not avoiding it." If 2022 has taught us anything, it's that risk management is necessary if you want to gain financial freedom and retire early. Your portfolio needs to be focused not only on return, but also on risk and potential downside. This is extremely important to find companies that are safe, reliable, and growing. We want to see healthy balance sheets and a stable track record of dividend growth. In this video, we will discuss my favorite safe dividend stock with over a 7% yield that you can rely on. Safe dividend stocks are like having your cake and eating it too. You get monthly or quarterly passive income, and you get capital appreciation from the stock price. If the price goes down, the dividend yield goes up. While I do enjoy the growth and safety of 1 to 3% dividend stocks, I personally prefer higher yielding companies because I can reinvest more money into my portfolio. With a higher yield, you receive higher cash flow, which can compound quickly. If I can find a high yield safe dividend grower, I am happy to research further. EPD is the safe dividend stock with a 7% yield that increased dividends. Enterprise Products Partners, ticker symbol EPD, is one of the largest midstream oil and gas companies in North America. This company has a massive network of pipelines that spreads more than 50,000 miles and connects to every major U.S. shale play. EPD has a large storage capacity of 260 million barrels of liquid and 14 billion cubic feet of natural gas. EPD is one of the largest MLPs globally with a market cap of $57 billion. MLPs, or Master Limited Partnerships, are unique investments that combine tax benefits of limited partnerships with the liquidity of common shares. They are organized as publicly traded partnerships, or PTPs. To qualify, a firm must earn 90% of its income through interest and dividend payments relating to natural resources, energy, commodities, or real estate. A huge benefit of owning MLPs is their benefit from taxes. Taxes are passed down to shareholders who must fill out a special K-1 form for tax purposes. This means lower cost of capital for the company, and dividends are not double taxed, which is great. With an MLP, investors receive more cash payments than the amount on which they are taxed, creating a nice tax deferral. Taxable income is only often 10 to 20% of dividends. Another benefit I love of MLPs is it is specifically designed to generate cash flow to shareholders. EPD has a high yield at a current 7.92%, which was increased by 2.2% on July 7th to 47.5 cents per share. MLPs can offer attractive yields because 80 to 90% of distributions are often tax deferred. With lower cost of capital, EPD is able to maintain more capital for future products and remain competitive in the sector. One reason I love owning this stock is its long-term, steady, and consistent contracts, which help forecast solid cash flow. Almost 80% of its contracts with shippers have been extended for 15 to 20 years. EPD is well positioned to create more cash flow from under-construction capital projects worth $4.6 billion. When looking for safe stocks in the energy sector especially, we need to look at how well the company has done throughout recessions and cycles. During 2019 and 2020, when oil prices plunged due to decline in demand, EPD's distributable cash flow only fell 3%, making this an impressively resilient company. Even more, Enterprise is well diversified, owning pipelines, storage, transportation, assets, and refineries. It's important to look at profitability when researching a reliable company. We want to see net income and revenue increase over time. Looking at a 5-year chart, we can see EPD is getting over the 2019-2020 hump cycle, but revenue is back on track at an all-time high. Annual revenue for 2021 was $40.8 billion, which is a 50% increase from 2020. While revenue is a bit cyclical, the 10-year net income shows an impressive uptrend since 2009. Net income for 12 months ending in March 31st, 2022 was $4.55 billion, up almost 22% year over year. Another huge metric to look for when finding reliable companies is how much debt they have. This is extremely important because as shareholders, we want to see management being conservative and not being highly leveraged to produce more cash flow for our pockets. A highly leveraged company could eventually fail, and as a shareholder, you would be left holding the bag. EPD has a long history of being conservative, with its balance sheet being one of the strongest in the sector and one of the lowest debt ratios in the sector. Debt to EBITDA ratio has decreased from 4.79 to 3.58 since 2009, showing management continues to lower debt. Now let's look at the dividend. EPD has paid and increased dividends for 22 years consistently, and even raised its dividend during 2019 and 2020. This proves the company values shareholders, and while we want to see a reliable balance sheet, we also want to see consistent and growing dividends to make sure our money grows above inflation. EPD paid 68 cents per share in 2013, 37 cents in 2015, 41 cents in 2017, 43 cents in 2019, and currently yields 47 cents per share. Looking at its 10-year dividend growth rate, we can see a nice, steady uptrend. It increases dividends every year at an annual average rate of 5.92%, meaning the dividend doubles every 12.1 years. It has a payout ratio of 81.96%, which means the dividend is safe and sustainable for this MLP. As for the future of EPD, Q2 results just came out with the announcement of expansion into the Delaware Basin with 3 organic growth projects. This includes 2 natural gas processing plants and the expansion of the company's natural gas liquid pipeline system. Enterprise will be able to produce a total of more than 275,000 barrels per day, or BPDs, of capacity with completion in the first half of 2024. The basin is the driver for U.S. production growth of crude oil, natural gas, and NGLs, or natural gas liquids, that support increasing energy demand, especially during the geopolitical crisis with Ukraine. Management says these projects are a great opportunity to increase revenue while returning equity to shareholders. Q2 EPS came in at 64 cents, beating the 1 cent estimate, and revenue beat of $16.6 billion versus an estimate of $4.1 billion. So they handily beat estimates. EPD also saw a record level of gas pipeline volumes and record distributable cash flow of $2 billion. Overall, Enterprise beat estimates and had record volumes due mostly to its gas processing and octane enhancement businesses. Despite what you may have heard in the media, demand for oil and gas is expected to increase 18% by 2040. EPD expects significant growth in energy forecast as the population is expected to increase by 1.8 billion by 2050, with growing developing energy needs across the globe. EPD and other U.S. oil and gas companies will be the first in significant carbon capture projects and have already begun implementing them. So, while EPD looks for alternative energy sources, oil and gas demands will continue to grow as well. With a strong balance sheet, safe and consistent growing dividends, and a record quarter, EPD seems to be a good company to own, and while the PE ratio seems to have recovered from 2020 lows and is now back to normal, if you are willing to hold EPD for the long term and buy on dips, the dividend yield may provide consistent passive income. While this is not financial advice, I believe EPD is a buy and hold forever stock that you can feel confident owning.